I reviewed every ETF that launched in February 2026 so that you don't have to. Most of them were not worth my time. So let me save you some time and let's go over just the good ones. So quickly before we jump into the funds that I want to highlight, I want to talk about why I excluded so many. Part of it was that there were just a lot of leveraged funds. I don't endorse daily resetting leveraged funds, and a lot of the ones that were introduced this month were on single stock positions. So it was like 2 times American Express stock. And those are ETFs that I'm just not interested in. So 21 of the 89 go into that category. There were also 7 buffer ETFs. Buffer ETFs trade options collars. They're effectively like a guaranteed floor and ceiling. I don't think that they're suitable for most people who they're marketed to, and so I leave them in the no pile as well. And then the last kind of ETF was a little weird. I'm going to throw up a little chart here about the payoff of these. They're autocallable ETFs. So we've been seeing a lot of these too. Autocallables tend to also be called barrier options, and among other names. Essentially, they offer a coupon, usually like 10% or something close to that, sometimes up to 13 or 14%. And in exchange, you get no upside on the vehicle that you're buying on. So say you buy the NASDAQ 100 as an autocallable, you'll get 10% per year, and you won't get the return of the NASDAQ unless the NASDAQ falls below a certain threshold, a barrier. So in this case, some of these autocallable ETFs were at 40%. If you fall below 40%, the coupons stop, you no longer get any yield, and you incur all the capital losses of that 40% drop once it passes that 40%. The worst part is that they're auto-callable, meaning that they are called from you at specific times and at specific circumstances. These are almost always incredibly heavily favoring the issuer of the auto-callable and not the owner of the auto-callable. Because of this, all of these funds just go in the no pile. All right. So let's talk about funds that might actually be interesting. The first thing is that there were CLOs everywhere. If you don't know, a CLO is a collateralized loan obligation. It's kind of like a bond, but it comes with a floating rate. And those are typically sold in tranches that vary by risk. There were a lot of AAA CLOs, which are usually seen as like close to cash equivalents. They have more risk than T-bills, but not by very much. And there were a couple funds. The first one that caught my eye was that Fidelity has finally entered the CLO ETF arena. They launched FAAA and FCLO, which are 2 funds that carry AAA and lower grade or B to double B CLOs. Effectively, FCLO is closer to like a high yield bond, and FAAA is closer to like treasury bills or short-term treasuries. It is to note that both funds have no duration, as is normal for CLOs, so when rates change, their prices are not always affected so much. But their yields will be affected, and if rates go down from here, then you can expect CLO funds, including these new ones from Fidelity, to pay less as well. On the CLO topic, there was a fund launched a couple months ago called RAAA, which is a AAA CLO fund run by a company called Reckoner. RAAA is actually a leveraged AAA CLO fund, so it's 1.5 times leveraged. That's why they use the term enhanced yield. So you should expect 1.5 times the yield, but 1.5 times the risk as well. They just launched 2 new products, RAAY and RAAR. These are products that hold RAAA, and they are changing the cadence of payouts. So RAAA pays monthly, but RAAY, the Y for yearly, will pay annually. So it'll pay once a year, probably at the end of the year. And then RAAR, the R standing for reinvest, is ideally going to pay no distributions. It's currently unclear how that's going to play out, or if the distributions that are made are going to be return of capital or some kind of accounting format like that. But the goal from the fund managers is to hold that 1.5 times leveraged CLO and then never pay distributions and reinvest the proceeds. It should result in some tax savings, though, like I said, this is kind of uncharted territory for both CLOs and leverage. So it's unclear how this is going to turn out. These have made it onto my radar, but I'm not invested in them, and I'm not quite interested in CLOs at the current moment, given all the ongoing problems in private credit. There are 12 funds that I think are worth considering from the month of February. I'm going to list them in the order of launch. So just consider that this is not like a priority list or anything like that. It's just listed by what came first in the month, and then we scroll down from there. The first fund is actually a crypto ETF. This is the ProShares CoinDesk 20 Crypto ETF, ticker KRYP. This is a crypto index that owns the 20 largest cryptocurrencies. I'm not a huge cryptocurrency investor. I recently got rid of some of my crypto that I've been holding for a while. And so I'm not interested in this, but I can see an investor who wants access and exposure to cryptocurrencies, but is wary of the idiosyncratic risk of owning a singular cryptocurrency. If there's an issue with Bitcoin or Ethereum or Solana, then you can expect to have an issue if you're only invested in that currency. To avoid those kinds of things, just like with stocks, we invest in index funds. It's a fairly reasonably priced fund at 0.58% a year. It holds 20 of the largest cryptos. It's currently like 30% Bitcoin, 20% Ethereum, and then the remaining 50 is kind of split across the other 18 coins. The next one, the Global X Commodities Strategy ETF. Ticker COMD. I am very bullish on commodities, and if you follow my model portfolio over at my newsletter, you will know that I have incredible stakes in materials, firms, and commodities right now. I think commodities are a great source of returns for the next coming years, especially as we walk into a bond and equity market that is really overpriced, and a commodities market that has not seen much love. There's lots of macro arguments for this too, and I won't talk about China right now, but just know that this is similar to funds like HGER or SDCI. Essentially, COMD is designed to be long-only commodities, and so it is trading commodities. It's not systematic or trend following. It's actively managed, but it's trading long only. So they're never short. It's not like a managed futures kind of deal, and they're only invested in raw commodities. So currently their largest holdings are gold and oil. That brings us to the ProShares Genius Money Market ETF, ticker IQMM. This is a cash equivalent ETF that is completely compliant with the Genius Act passed last year. I'm not a legal expert, and so I don't know all of the minutia that is required in being compliant with the Genius Act. I know one of the things that is very important to it, and this is one of the things that would make IQMM interesting for individual investors and not just institutions who are worried about Genius Act compliance. The fund entirely holds zero coupon T-bills. So it's short-term treasuries that don't pay coupons on purpose, which means that they will not be paying any interest or coupons. The fee's super reasonable. It's a 0.15% expense ratio, so that's solid. And if you were an institutional investor that needed the Genius Act compliance, this is the first of its kind, but I expect more to come as well. Okay. The SDMF ETF is next. This is the same ETF, same exact holdings, should be almost the exact same return profile and profit and loss every day. It's the same as the DBMF. This is a managed futures fund that I personally own and have written articles about on Seeking Alpha. But effectively, it's a fund manager, or fund managers, in this case it's a basket of them, trading commodities. So it takes their aggregate positioning and then it replicates that in its own portfolio. SDMF, simplifies version of DBMF, does the same thing, but it's using swaps on DBMF. This means that its returns are not the returns of commodities, but the return of a derivative. And derivative returns tend to be tax advantaged or tax deferred. Oftentimes, they can be returned as return of capital, which allows you to defer taxes and count your distributions against your cost basis. So if you're a DBMF investor, you're interested in managed futures, but you're investing in a taxable account, SDMF may be a great option for you to avoid some of those taxes or at least defer them till later. All right, we got SMRF. This was the ALPS Nautilus SMR Nuclear and Tech ETF. Effectively, this is just like the nukes, the NUKZ ETF, where they are owning the entire chain of nuclear power from uranium miners all the way to utility operators. And their focus is on designers in particular. That's the SMR, the small modular reactor. So this is the new nuclear tech that firms are working on to try and produce very lightweight reactors that can be deployed easily. They don't come with as many risks, but it's kind of a new, unproven technology that's just being rolled out. So this is very speculative. I brought this on here because I think that this is actually competitive with nukes. And if you were interested in the nuclear thesis, and I hold this just like the crypto, I'm not interested in the crypto thesis, but I gave the crypto fund a positive rating because for crypto investors, it's a good deal. I think this is very similar for nuclear investors. So if you're already interested in the nuclear bull thesis, then consider SMRF instead of nukes or an older fund like NLR, which has a much higher expense ratio. Okay, this brings us to the Van Eck Communication Services True Sector ETF. These True Sector ETFs are interesting to me. This is the third one that Van Eck has put out behind the discretionary and technology ETFs. Effectively, they were looking at the traditional sector funds. State Street has the most popular ETFs in this. They have the X series. So communications is XLC, for example, and that holds the communications sector of the S&P 500. But XLC has some rules that it does not share with the S&P 500. Namely, it has concentration rules. So XLC has a limit on how heavily allocated it can be to certain stocks in its portfolio. The S&P has no such weighting. It's just market cap weighted. This means that if you look at the communications index in the S&P, it has a heavier weighting to Meta and Google than XLC does. XLC introduces these arbitrary rules. So Van Eck is trying to fix this by creating TRUC, TRUC. And essentially, they want to buy Meta and Google on its own so they can fix the gap between XLC and the actual index in terms of weights. And then with the rest of their funds, they just buy XLC. So it's an XLC with the biggest players overweight compared to XLC, but TRUC should be as close as we can get to the actual index weightings if that was important to you. So consider that TRUC is kind of this philosophical argument, and you have to decide if you like the concentration weightings or not. Certainly, XLC by comparison would be more diversified since it's less concentrated in the top holdings. But that also is a decision that one is making to stray from market weights. And for many of my bogglehead investors that prefer to have everything set at market weights, the true funds may actually be worth your time. The last ones I want to talk about are a series of ETFs that are all running together. So this is MYHA, B, C, D, and E. I'll show those on the screen now. State Street is essentially buying high-yield corporate bonds that have a maturity and then not rolling them. The plan is to hold them to maturity. And then distribute all of the proceeds to investors and end the funds on the end of their expiration date. So MYHA is in 2027, MYHB is in 2028, so forth and so on. This allows investors to create their own ladders without buying individual corporate bonds. So you're able to own an index of corporate bonds, in this case, the junk bond index. So you would be buying the high yield index, but you wouldn't have the rolling mechanism of an ETF. This means that you're never being forced to buy or sell your bonds. You can just buy them and hold to maturity. And you would do so by laddering, you would put some into 2027, some into 2028, some in 2029. And as the years go on, State Street will launch more of these funds. And so you'll be able to roll, if you were interested in having a rolling ladder, you're able to roll the 27 into a 32, probably next year. Though I'm unsure when State Street is going to produce more of these. Okay, I skipped one, and that was because I wanted to highlight specifically my favorite ETF of February 2026. So of all the ETFs that launched last month, I found the Invesco Flexible Income ETF, ticker FLXI, to be the most interesting. Essentially, this is an actively managed bond portfolio that is meant to be kind of a one-stop global shop for bonds. The fund is able to position itself both across duration as well as across the yield curve. So they're able to position the fund very advantageously based on their macro assessment of the bond market. They're also able to invest ex-US. And so when I was looking through their holdings, of course, the holdings are very fresh because the fund is a month old, so they haven't deployed all their capital yet. They have a lot of holdings that I think are going to be placeholder for now, and they're going to be deployed later. But for now, their first big deployment was into Fannie Mae mortgages and sovereigns from the South African government. This is interesting to me, and I would never have picked sovereign bonds from South Africa, but perhaps that's why I'm not running an Invesco fund. They've got a different vision of the markets than I do, and a lot of information, and they're trading it actively to make smart and informed transactions that should hopefully outperform the aggregate index. Will it? I don't know, but it's got a good shot, and I looked through the fund managers and who they were, and I like their credentials. So I'm willing to give it a watch. And I think if you're a bond investor and you like bond funds, and you're especially willing to allow some active management in bonds, which is I think where all of the alpha is in bonds, is not in security selection outright, but in the active maneuvering of bonds. And so I like funds like FLXI for this reason. It should be of note that they're also able to trade currency forwards. And so I imagine that on top of the South African bond that they're holding, they're also hedging their rand exposure. But that's unclear to me because the holdings don't tell you what currency they're trading, just that they're trading currencies. And to top that all off, its expense ratio is 0.39% a year, which is really good for the amount of work that they're doing. And I know a lot of bond funds that charge double or triple that. And we won't even get into the CEF world. Okay, that was a quick review of the funds that launched in February 2026. If you want to see my notes on every ETF and you want my full rundown, check the link in the description for this sheet. It is free to anybody to go view and copy. Go ahead and make your own notes on it. If you made it this far in the video, I know that you'll appreciate my newsletter where this was sent out first before YouTube, with all of my written notes and a write-up for these ETFs. If you're interested in that, check the link out below or go to jackbowman.link/newsletter. Take you right there. It's free to join. You get it once a week for my regular macro content and once a month for ETFs, where you'll get this before anybody else does and way before YouTube. Thanks for watching, and I'll see you next week.